A good day to you, and thank you for joining us on another round of the East African Focus Debate, this time round putting a spotlight on developing East Africa's commodity market. On my panel is Dr. Kadri Alfah. He's a country manager, East Africa Exchange. I have also Antonio Pedro. He's a director for Sub-Regional Office for the East Africa UNECA. Now, the latest 2016 Commodity Markets Outlook report by the World Bank has projected a decline in the price indices of all the main commodities. Now, this is partly due to persistent elevated supplies and weak growth prospects in the emerging markets, economies, and the world. This has been coupled by a lot of currency fluctuations and a dwindling global commodity price. Now, joining me this morning to just help us understand this, gentleman. It's very wide. The commodity conversation is an ending, but just in a sense of the opening remarks, and I'll start with you, Pedro. Give us just a picture of where we are as East Africa in the wider context of the commodities market.
Thank you, Bonney, for once again providing me the opportunity to talk about this very important subject. As you've indicated, commodities are now facing what we call a bearish market, in the sense that prices for most of commodities, hard and soft, are going down compared to a situation in the early 2000s when we had a bullish market, a super cycle where most of the commodity prices had historically high. So, and equally, as you've indicated, there are a couple of factors that are driving that. China's appetite for natural resources have flattened a bit because of the rebalancing of the economy in China. And they are now trying to push more for consumer-driven growth. The overall state of the global economy also is a major important factor. I mean, with the exception, I would say, of the United States, most of the other regions are not growing at high rates, and that, of course, has an impact on the demand for commodities. Well, there are very interesting figures there. I mean, look at oil. I mean, we were talking of prices almost reaching $200 in the early 2000s. Now we are talking about $39 today. So the same applies to iron ore. So that's the environment in which we are sort of having this conversation today. But for example, if you look at tantalum, which is coltan, which is a very important commodity for Rwanda, you'll see that in the years 2000, the prices were about $350 per pound. Then in the year 2005 to 2009, it went down to about $40 per pound, and now we are at $123 per pound. What am I trying to say here is that this volatility in prices is a feature of the industry. So countries, therefore, need to master that and be able to introduce relevant policy instruments with a view to live with those kinds of fluctuations. So it is not something that has happened only now. I mean, if you look at the historical trends in commodity price, you'll see always those fluctuations. So this is a very important thing to take into consideration when we discuss the policy instruments and how, therefore, to reduce the exposure to those external shocks.
Right. Kadri, in a sense of your opening remarks as well, give us a picture of where we are, but in special interest to what is biased to your interest, that will be soft commodities.
Yeah, thank you very much for giving us the opportunity. Yes, soft commodities generally, we know that in some instances, the countries have their policy initiatives to produce more of these commodities. But traditionally, these commodities have been exported. And demand from other countries have been relatively weaker. Generally, because most of these countries which are actually buying these commodities have also somehow, they haven't experienced some sort of good growth in terms of the economy. The industries that would normally use these commodities hasn't done very well, and they have actually, cut on actually the use of it. So generally, the issue here is that in East Africa in particular, what is the way forward for what is the way forward? What do they do? One of the things is that how do you create demand within the East African community itself? I think one key element is that how do we ensure that there is substantial demand here, because the emphasis has always been on exporting it. Mm-hmm. So how do you create a demand here? Right. I'll give an example of in Rwanda, where the demand for maize, good quality maize, have been very high here, yet the supply is low. So the point is that, is it possible to source out these commodities from maybe a country like Uganda, mm-hmm. where there is a deficit? And it is also an issue of the quality of it. So these commodities, so I think the emphasis should not only be on exporting it, but how do we create demand within within our territory,
the region.
Yeah.
And Pedro, you raise a very important point that the super cycle is part of this. We'll always have a super cycle whenever we have in dealing with commodities. The problem is that we've banked a lot of our planning on those super cycles. The Africa Rising narrative was pegged on the super cycle. We had a surge in commodity prices, our teas and coffee and gold, and everything was doing pretty well. And we thought, finally, we've gotten our act right. We now have a slump. All commodities are headed south, and we are wondering, is Africa still rising? Give us a sense of how do we know that there will be a cycle. We are now at the bottom of the cycle. We might get back. But how then do we design policy instruments that are aware of this unique nature?
Yes. Well, in line with what Dr. Alfah just mentioned earlier, I think one major opportunity is to look at Africa mm-hmm. and intra-Africa trade and opportunities arising out of there. A couple of years, about 2 years ago, during the first East Africa Manufacturing Summit, mm-hmm. I advocated for resource-based industrialization mm-hmm. aimed at making the most out of our commodities, looking internally at our own dynamics. And what are those dynamics? First, of course, as everybody knows, our population is rising, and with it, its consumption of manufacturing right. Goods and so on is also increasing. So there's an opportunity there to try and now reverse our policies, which, as he correctly indicated, have been mostly export-oriented. Right. And the super cycle, the commodity prices were really, providing the necessary fundamentals for such a model. Right. Why would you invest in long-term basics, essentially fixing your infrastructure, creating or improving your skills base right. so that you can have a competitive manufacturing if you can sell your raw materials at a very high premium. So that was part the rationale behind the model. Now this gives us an opportunity to first look at what Africa offers as a market. Right. By 2050, we'll be about 2 billion or so people. Right. You've heard, and everybody heard, of the rising middle class, which would want more cars, which would want better infrastructure. But the problem is that
everyone is looking at Africa as a market, whilst we are not developing Africa as a manufacturing space. And that will always have this issue of trade imbalance, because everyone is looking at Africa as the next place to come and sell to. No one is looking at Africa as a source.
Well, even within that context, that everybody is looking at Africa as an investment destination. We've heard that as part of the rebalancing of China's economy, right. as part of their own worries with the environmental footprint, they are now trying to relocate some of their industries. Right. It is possible, therefore, to try and attract those Chinese industries to Africa on the basis of the strength of our commodity base.
Right.
So we're inverting completely our conversations and the nature of our trade patterns with China that now are essentially based on the export of natural resources to now inviting them to Africa to establish industries that are linked with that natural resources base. Right. The good news is that a couple of studies, and there is a very interesting study by a gentleman called Thomas Gerder from the Yale University, right, which has done a study for the International Resources Panel on integrated scenario analysis, which look at what will be the resource requirements globally by 2050. Right. And there are a couple of interesting figures out there. For example, things like cement will be in short supply. Right. So that gives an opportunity for us to look at those kinds of neglected sectors. I mean, you know that most of our solid mineral sector is focused on oil, gas, precious metals, right, and so on, and metals.
All of which are experiencing tough time right now.
Neglecting the industrial minerals. Right. I mean, the things that are the basics for running a society. So we need to emulate examples like Dangote, that, as you know, is investing quite a lot in the cement industry. And the numbers are suggesting that there's an opportunity there. Right. Also, with the climate change agenda, and the need to reduce the carbon footprint, invest in renewable energies. There's opportunity for some of these rare metals. And for example, if you are talking of electric cars, you are talking of lithium. This is a mineral that will, if everything goes according to plan, which is of course asking too much, you will see lithium prices going up. Right. Even tantalum, its input into electronics is going to increase.
And we'll get to that because there's an argument that as much as we have all these resources, African economies are not getting value for it. We'll get to that.
Let me just add to
I'd like to respond to that.
What Andrew is saying. Yeah. I think it is what is important is for us to look at, we have to sit down and review, just analyze on all this sort of traditionally African being a traditional exporter of raw materials. Right. We know very well that the prices of these raw materials are plummeting. And the issue now is that what do we do about it? And I think, like Andrew... Pedro rightly said, we have a situation that there are demand for other specific products. I mean, soft commodities and hard commodities. The point is that how do we strategize ourselves to ensure that we are in a position to provide those things? I mean, traditionally, we've just been exporting certain raw materials, and those raw materials haven't helped us. Right. So the point is that how do we I think it's important that we sit down and re-strategize, and then we know what is going to be of value to us and the kind of raw materials that would meet the needs of those markets, and then we provide them.
Right, and I wanted you to react to also the other issue that whilst we talk about improving our capacities and coming up with policy instruments, we cannot overlook currencies. Yeah. This is where all this is based on. And a lot of the African economies, East African economies, have suffered from currency depreciation. I mean, across the board and across the sub-Saharan Africa. The Ugandan unit, the shilling, the Rwandan franc, Burundian franc have all suffered considerably against the US dollar at a time where the US dollar is doing fairly well. These has obviously messed our import-export bills. Give us, from your experience at the East African Trade Exchange, how you navigate this whole currency depreciation conversation.
Well, I mean, the reason why these currencies are not performing well is just the fundamentals. I mean, it's just the economy. I mean, if the economies are not strong enough, then or if the economies are driven mainly by, by export, and then you don't have a very strong production base, then basically you always need to bring things from abroad.
Right.
And so these are the fundamentals. I mean, at the East African Exchange, we are a regional exchange. We look at the regional market, and one of the problems we have is how do we actually mitigate against this sort of exchange risks. This is a risk that we're facing. And so what we try to do is that, I mean, instead of looking at the dollar as the denomination, what we do is that we trade in countries and on all the currency, and we try to establish what we call the market points in all the countries, so that we don't necessarily have to deal with dollars in terms of. So we manage it. I mean, it's very difficult for any entity to be able to control currencies, because there are so many factors that feed into why a currency is doing well or is not doing well.
Right, but Pedro, before I get to Pedro, Kadri, well, you encourage the use of other world currencies.
Yes.
This is really driven by demand.
Yeah.
If someone doesn't want to use the yuan, they will not use it. They will go to the dollar.
Yeah.
And there's a situation that most of the trade is either dollar-driven or euro-driven, which are almost at par right now. This whole depreciation may be good for the short-term exporters like yourself, but can we draw a long-term plan to ensure that we cushion against some of these pressures before we come to Kadri?
Yeah. I think yes. I mean, the long-term plan is for us to look at these currencies, and then we ask ourselves that, in the longer term, for instance, how do we improve particularly maybe our export, our production base, and how do we draw, instead of us to actually always go out and get people to go to people, why don't they come to us? I think also, even in East African itself, maybe you have to look at the EU, for instance, where they have one currency, and the one European currency is a big step towards trying to reduce some of these currency fluctuations.
Right.
And then they also have a policy. They have a common policy on interest rate, on this even currency rate, and these are all initiatives that would help.
Right.
But from the wider perspective, let's just not narrow ourselves only into
the dollar.
Into the dollar.
Right. There's a lot more.
There is a lot more to it. Yeah.
Pedro.
Well, I want to look at the issue of exchange rate depreciation from two perspectives.
Right.
The first is that if we had strong manufacturing base, or weak currencies could help us be more competitive, which would therefore buttress the point about the need to go the manufacturing route, because the vulnerability to price fluctuations is lower in the case of manufactured products. So that's one aspect. The second is that the very fact that we have this exchange rate depreciation is a reflection of our dependence on commodities.
Right.
Because our export-import balance became it was negatively impacted because of the reduction in export revenues, and which again suggests that the route to go is to value add, to use our natural resources to build an infrastructure base.
Right.
So that's my overall, how do you call it, point about the the exchange rate situation. Of course, I fully support the idea that the region as a whole will need to have a strategy, so that you don't have unfair competition within the region because of differences, for example, in exchange rates.
And let's get to that, because the other pressure, the other reason why we suffer a lot of pressure, like you've pointed out, is the reality that East Africa is a net importer. So as much as we're pushing for exports, as much as we're doing all these things, we simply have to import to survive. And that's the reason why we have to be put under this pressure that even at times where probably our currency does not favor us, we don't have an option, but we still have to import. Let's talk about addressing that import dependency. And a few people have thrown around the idea of import substitution, that we can try and import from our neighbors, and that will reduce the pressure. Kadri, talk to us a little bit about that, because that really falls within what you do. Is import substitution a reality in East Africa? Can we make it a reality?
Well, maybe in the short term, yeah, but in the longer term, it's just going to be very difficult. I think let's look at the broad picture here. I mean, the reason why we are net, we are net importers is just simply because we don't have a very strong production base. I mean, in terms of manufactured goods, I mean, what we are doing is that we are producing a very low value agricultural products and exporting it. And when you do that, you are extremely vulnerable because you can't dictate the prices. I mean, value added goods are rather the way forward for us. And because in the first instances, it is just about the demand and supply balance. You have a situation where you are producing goods that people have, people can get anyway. I mean, most of the goods that we are producing here with agricultural products and exporting it, other countries are also doing the same. The only thing is that they would only require ours when they have actually exhausted, their stock. And so that is the reason why they're detecting the prices. And this is all linked to currencies as well, because if you don't have a very strong economy, then then your currencies would.
What is the reality of Kenya saying we will not import sugar from Brazil, we'll get it from Uganda, or say we'll get our maize from Malawi, whatever other country? What is stopping us from doing that?
Well, we can do that, but the point is, you have to look at it in a sustainable way. The point is, if Kenya wants to import sugar from Uganda, for instance, does Uganda have the sugar that they want? First of all, you look at it in terms of, and is it sustainable? Can Kenya rely on Uganda? That's the point. Because obviously it's going to be much cheaper for Kenya to import from Uganda. But does Uganda have the sugar that Kenya wants? In terms of the quality that they want and the quantity that they want? That is the same thing that we have in the exchange as well, in where we try to get commodities from other countries.
So as much as you'd want, we simply can't afford that.
Yeah, well, I would like to offer a slightly different perspective. First, to say that import substitution a la 70s and 80s doesn't work now, because you have provisions in international trade regimes that block you from doing that. I mean,
and we'll get to the unfair nature of some of those trade regimes.
For example, I mean, as everybody knows, the East African Community has ratified the economic partnership agreements with
under pressure, we must add that.
That alone limits the scope at which you can utilize the old models. I mean, the excessive tariffs and so on as a means to protect your infant industry. We will be launching during the Conference of Ministers of Finance and Economic Development on the 2nd of April our think piece on smart industrial policies, which is essentially a blueprint on how to promote industrial policy in the 21st century, take into consideration some of those limitations in the policy space that you can secure arising out of these trade regimes. And what are we saying there? That, well, for example, you can subsidize research and development. After all, the United States does it. I mean, for all of their agenda on on future energy supplies and so on. There's quite a lot of money that is pumped towards supporting research and development. Why is it that we don't do it?
Exactly.
So it's a recipe of suggestions on how to navigate the barriers of international trade regimes whilst you pursue your industrial policy, your goals of having a manufacturing base. And that is import substitution a la 21st century.
Right. I'd like Kadri to respond to that because we're just about to take a break. But after the break, we'll delve a little bit deeper on the protectionist tendencies and whether or not they're beneficial for East Africa. But quickly react to the point.
Yes, I think we still have a lot to do in terms of when you look at some of the policies that, individual countries have in place just to protect their own industry. We still have a lot to do there, because you have a situation like, and the thing is, when individual countries are looking at imports, what they look at is they want to look at imports that is at very competitive prices.
Right.
So if it is easy for them or it's much cheaper for them to probably buy from China or buy from somewhere else, then they're going to do that. But the point is that within the East African Community countries, for instance, is it much easier for us to trade within ourselves?
Pedro, I know you want to jump in, but I'd like you to just hold the thought. We need to go into a break, and we'll get you a chance to respond to that. But you've been watching the first half of the Developing East Africa Commodity Market, an East African-focused debate by CNBC Africa. And what we try to do here is try to unwrap and leverage on the competitive advantage that the region has as far as trade is concerned. Do not go too far. We'll be back after the break. Welcome back. You're watching CNBC Africa's East Africa Focus Debate. This time around, we're putting a spotlight on developing East Africa's commodity market. I've been speaking to Dr. Kadri Alfah. He's a country manager, East African Exchange, as well as Antonio Pedro, director of sub-regional office for the East Africa for UNECA. My name is Bonney, Tunya. Gentlemen, we obviously got a few points that came out clearly in the first half, but I'd like us to kick off with that conversation of are other trade commitments, obligations, or treaties affecting how East Africa's commodity market is taking place? And Pedro, you alluded to the fact about, for example, the signing of the EPAs with Europe. I'd like you to just kick off with how do we best use some of these relationships that we have to advance our commodity market?
Well, I think it's important that Africa speaks with one voice and uses that voice to influence global processes. We have done it very effectively in the formulation of the Sustainable Development Goals, right, which, as you know, are to a certain extent anchored on the common African position on the post-2015 development agenda. Mm-hmm. So most of the key tenets of the common African position are reflected in the Sustainable Development Goals. So that's a clear example where Africa was capable of speaking with one voice and using that voice to influence global processes. The EPAs process was a little bit more complicated because first, we were balkanized in different formations, some of them which was not clearly linked with the regional integration architecture. Right. And all of those factors might have contributed to, let's say, weaken, if any, Africa's position in those particular conversations. But I want to go back to what we were discussing earlier, to say that Africa transformation is an imperative. And this was clearly articulated during the African Transformation Forum, which was held here in Kigali. Right. And going the manufacturing route and the Africa's transformation and structural transformation, at the core of structural transformation is industrialization. So the key issue, therefore, is how can you industrialize how can you utilize industrial policy instruments in the context of, for example, those restrictions that we were mentioned earlier? One is to use better our bargaining power and being strategic and have targeted investment drive, so that you bring to the continent those that are aligned with our aspirational goals. And using our bargaining power effectively means, again, that we have to market ourselves as a block. Look at our endowments, not as individual and country-specific endowments, but endowments of the region. For example, if you look at East Africa, you could argue that, well, with the discovery of oil and gas in Kenya, Uganda, Tanzania, and Sudan, which I'm sure will join the East African community soon, you have the necessary energy base to pursue industrialization, because the energy is a very important factor in building competitive industries. And if you look broader than the EAC space, then you have, for example, in DRC, a massive mineral resource wealth whose potential for industrialization could be catalyzed if we start now looking at this space more as a regional space. And then you engage your potential investors from within and outside Africa from a much better competitive sort of
I'd like to
standpoint.
just suppose and bring in Kadri on this whole issue of bettering our negotiating and our bargaining at the table. And he alluded to that whole issue of there's restrictions based on the different relationships, and these relationships and trading blocks are inevitable in the global trade that we're talking about. Give us some of the challenges you faced from the region as far as your bargaining space, your position at the table, and how can East Africans best tackle this? Because he's mentioned we need to come together. So there's that blocking, coming together in sort of blocks that will help in negotiating. But what are some other practical measures of improving our negotiating?
Just to just highlight on it, I think many countries have that kind of protectionist policies. They want to serve their own interest first. That kind of emphasis on looking at the regional interest is no longer there. It's not yet there. And I think the leadership of the committee is working on that. This is very important. And then secondly, also, some of these countries have actually gone into some individual relationships and some individual sort of contracts with other nations, which is imperative that they are able to, to implement that. And so this is also one of the reasons that is impeding the progress. So the first is national interest. The second is that there are other countries that have gone into other relationships. Even some of these relationships are political in nature. And it is imperative that they have to be able to do what they're doing. And the point is that how do they come out of this? And maybe some of them went into this kind of relationship. We have to remember that the whole East African community, for instance, all the East African community issues, probably is not, just came up and it was more active, maybe more recently. But other countries also had to, promote their own individual trade. They had to also promote their own political policies and other things. So I think it is important that all these ones are looked at. Is there
a level of protectionism that is good for present-day global trade? Because different countries have different ideas of protectionism, and whenever you try to advance that, people will argue probably protectionism has no space in global trade. What are your thoughts on that?
Yeah, I think looking at global trade in general, protectionism hasn't helped a lot, because what it has actually done is that it has actually alienated, many states, particularly in trying to, in trying to create more revenues for trading with others. Because when you want to protect what you have, or when a country wants to protect what they have, then you end up, having not to be able to engage with others. And this is what we're saying, and like, for instance, I'll give you an example, like the EU, for instance. It's been very, very difficult for some African countries to be able to export into the EU because they have created that kind of protectionist bloc. And it also, it has a political implication. And because of that, other blocs also would also equally put that in place as a form of retaliation.
How then do we as...
sorry, well, I would like to say that even developed countries, they use some form of protectionism for the strategic industries that they think should not be subject to, for example, takeovers and so on and so forth. We've had cases, and sorry for using my mining background as an example of that. For example, the China Coal once wanted to buy two of the major Australian-based mining companies, Rio Tintos of this world, and because of the strategic importance of those companies for Australia, the government blocked it completely. So it's not a tool that is only used by developing countries. In the uranium industry in Canada, there is a certain degree of ownership beyond which foreigners are not allowed, and so on and so on. And I could cite other examples. So it's really how you use it. I, for example, suggest that if you have very clearly articulated strategies, you can use sunset clauses to protect your industry. What is important is what you do within that period in which those companies or that sector is being sort of protected. You have to invest into building the productive capabilities so that they can then become competitive outside of the protection.
Who says how far is too far?
I mean, that's the prerogative of governments. I mean, they have to have a very clear vision about what they want to achieve out of that.
I agree with Pedro, but we look at it like most, some of the examples that we're seeing are just individual countries who are trying to maybe protect their national interests. But the point here is that to what extent, and then how far is that going to go, and what is the impact on maybe trade in general? Who is something that they need to look at, because if you want to protect an industry, for whatever reason, the point is that to what extent are you going to be doing that? Do you have to sunset clauses? Yes, So do you have to do that? Do you have to do that forever? Because some countries have been instituting this protectionist policy for a very long time now, and then they don't even have the incentive to sort of, they don't know that the global trade has changed. They don't have the incentive.
And that is a position a lot of African economies find themselves, especially in global conversations like the WTO. A lot of African economies go to the table of discussion without a position. How do we, and probably UNECA would be able to build capacity on this. How do we build capacity to ensure that our negotiators go there with a lot of information, but with policies that grow the local sectors as well as facilitate global trade?
Well, indeed, as part of what we call the Capacity Development Division, we have identified 4 critical sectors in which we are deploying the necessary capacity for instruments, development capacity instruments for member states. One is natural resources, so the entire issue of the negotiation of natural resources contracts, development planning, its statistics, industrial development, and so on. So it is important to build that capacity, because invariably, when Africa goes to negotiate even at the company level,
Right.
we are faced with a situation where you have one or two lawyers from our side, financial experts, and so on, confronting
a team of 100,
team of 100
Yes.
Supported by all the big five,
Right.
consulting firms. So that would create, of course, asymmetrical outcome. So it's important to strengthen our negotiation capacity. It's important to arm our countries with very, very solid strategies. We had a discussion during the African Transformation Forum, which, well, it's good to have very good visions, and for that matter, the East African community has now Vision 2050 that has articulated all of the key drivers for growth and sustained development in the region. The key issue is how to translate those visions into actions and change on the ground. And a lot of it has to do with implementation capacity, to identify and prioritizing which sectors do you want to focus on. And then it's on those sectors that you will channel your meager resources to build the necessary competence. And I'm talking about world-class competencies. Other countries have done so. I'm sure we can do it.
Right. I'd like us to shift gears a little bit and talk about a few issues that have come to fore as far as enhancing Africa's capacity in the commodities market. One has been financing the commodities market. However much we talk about the quality, we cannot achieve global standards quality if our producers don't have the capacity. Kadri, just kick off this one for us. What is the situation currently as far as financing commodities market is concerned, and what are the real opportunities, especially in East Africa?
Yeah, I think the general trend is that you see that most of the producers of agricultural commodities in Africa are farmers. They don't usually have the collateral, or they don't have what it is to be able to get the traditional support from the banks. You know, for instance, they live in rural areas. They don't have all the assets that the bank require. Now the point is that
conventional
banks,
yes.
yeah. The point is that the banks would usually ask them for collateral, you know, because the banks also have to protect their interests and others. Now the thing is, what generally is happening now is that the banks would have to focus on producing more tailor-made products for this sector. For instance, I mean, the East African Exchange, Commodity Exchange, we are promoting the concept of warehouse to see, whereby the farmers would actually get this kind of support from the banks using the assets that they have, and that is their grain, as the sole collateral to get funding, get loans from the banks. And the banks are able to advance them up to 70–75% of the value. So they don't actually need a traditional collateral. They don't actually
Are banks willing to engage in this new form of collateral management?
Yes, the banks are able. The reason why the banks, we also have to look at it from the bank's perspective. Why wouldn't the banks want? If you look at Rwanda, for instance, 37% of the GDP is agriculture, is 37% of the GDP. About 80% of people of the population is engaged, is employed in agriculture. Yet you have just about 6% of the banks, particularly I'm talking about the commercial banks, supporting of the bank's total sort of capital going into the sector. And then the reason the banks are citing is because they perceive that industry to be too risky.
Yes.
Especially
when you're dealing with fresh produce.
Fresh products. And the nature of agricultural products means that it needs to be handled more professionally. You know, you have to have better storage. You have to ensure that you are able to keep the quality. You have to have better packaging. You have to have better access to market. You know, and the bank and better information. And the banks lack that. They don't get that kind of.
Let me just bring in Pedro and also just touch on expanding this to hard commodities. What is our financing environment, and are there opportunities for improving this?
Well, I mean, I would like to say that what Dr. Alfah indicated is true, in the sense that, for example, Switzerland plays a very important role in the commodity markets, and yet it does not produce some of the commodities that are sort of traded through, through Switzerland. For example, copper, most of it is traded through a company called Glencore Extractor, which is based in Switzerland. So, and what does that tell us? It is really about building some of those soft infrastructure that is important for the role of financial institutions in facilitating the transactions, the warehousing, trading, and so on and so forth. So in line also with what we've said earlier, there really need for us to be able to harness the full potential of our commodity sector, we have to invest in some of those basics. Having not only the hard infrastructure that we talked about earlier, I mean, very good roads, airlines, and so on, but also the soft infrastructure, the financial instruments that can, for example, support transactions, having agile banking sector that understands the sector better. I mean, this idea of risks in the sector, I mean, will be magnified, I don't know how many times, if you're talking about hard sector.
Can some of these instruments be developed by governments, or do we expect the commercial banks and lenders to innovate?
Well, you know, these instruments are financial instruments, so they have to be developed by the financial sector. They can be banks, they can be microfinance institutions, they can be insurance companies. But what is important is that they have to meet the needs of the farmers. They have to meet the needs of the producers. There are circumstances, the producers' circumstances have to be taken into consideration. I've given an example of a situation where a farmer is required to have a house, or to have a car, or to have a very solid asset in order to be able to access a loan from the banks. You know, through the bank's own secured lending and system. Now, the farmer doesn't have that. You know, if you go to he may have a house in his village, but it doesn't have the value that would give the banks the comfort to be able to lend to them.
Even
you know, and nobody will even buy it because it's not marketable. So the point is that, how do you develop tailor-made products, you know, and what is the mix of these products, you know, because this is a highly, this is a group with a very special needs. And the point is that if you want to integrate them into the system, if you want to ensure that, you know, you are actually addressing the problem of financial exclusiveness, how do you meet the needs of this group? Because this group, I have said already, they employ about 80%, you know, they make up about 80% of the population of Africa, and this
commercial services sector must develop.
It must develop.
I would like to say that this of course would require tripartite partnerships, where, for example, governments would have to send the right signals to the financing sector, the private sector, as it were, to be able to be interested in the sector. And of course, you need to engage with the ultimate beneficiaries of this, which are the producers. If it's the case of soft commodities, the population, agriculture, and so on, that are the peasants that are in the agriculture sector, and have real conversations with them to understand first and foremost what kind of market failures they're facing, and then so that you develop, as you've said, products that are informed by their own needs, their own challenges, and so on and so forth. I think we have the example of the Ethiopian the commodities exchange, which really was a result of that kind of partnerships and conversations. So it cannot be done only by the private sector, the financial institutions.
I think the role of the government is usually to set the policy outline, you know, for this kind of financial products to be developed, as well as to give confidence to, you know, generally the market and generally everybody, the private sector. So the government is set. I mean, you talked about Ethiopia, for instance. In the Ethiopia Commodity Exchange, the government, and that is what the government of Rwanda is doing as well, is to set up laws or laws on commodity exchanges, set laws on warehouse receipts. These are all instruments that are very important for the development of a commodity market, a commodity market that would serve the needs of farmers in particular.
Right.
So that is the way the government comes in. But the financial institutions are purely responsible, or they are purely responsible for creating the instruments that would link, you know, the smallholder farmers to them.
Right.
You know, and that should be done in a systematic way, and it should be done with them having the needs of, you know, these farmers in mind.
Right.
If not, it's just going to be very difficult.
Gentlemen, to a frustration in mind, we have to end. We just have under 6 minutes of this conversation. As part of your closing comments, I'd also like you to comment about the current debacle we have about the Ugandan railway and whether it should pass through Tanzania or Kenya. And how would we, what are some of the possible recommendations? Because this is a real problem. There's huge potential in this sector. How best do we do this? The oil and gas industry in the East African space is still nascent, it's growing, and we are bound to face some of these challenges. So as you tie that comment to your closing comments, let's start with Kadri and Pedro.
Yeah, I think I want to look at it in a wider perspective. You know, we are looking at a market, a one common market where there is free movement of people and goods. So in my opinion is that I think it should. I mean, it depends on you know, because Uganda is probably also looking at it in the context of, you know, what value is it going to give to the economy? Are they really trading with Tanzania? But I think if we are looking at a common market where we want to see a free movement of goods and services, we also have to look at it in terms of infrastructure. How can we use this kind of infrastructure to promote regional trade?
Interesting.
Yeah, well, I think we have the East African Vision 2050. That is a very ambitious vision. Mm-hmm. They want to reach the upper middle income bracket by 2050.
Correct.
This is about $10,000 GDP per capita. So this is a huge, about 10 times increase from the current sort of income levels. This requires, therefore, a region that is very, very well integrated, that has diversified export routes. So I find it completely plausible to have Uganda linked to Kenya through a series of routes, linked to Tanzania with other routes, and so on and so forth. Because you need to be able to provide to the private sector and other stakeholders diverse opportunities to reach the market.
Right.
Opportunities that, for example, imagine if something happens in the traditional route via Mombasa. And so you need to have alternatives that are equally, competitive and equally, modern and so on and so forth. It's important to have this within the context of that. But my final words is that is to put this into perspective. And going back to some of the fundamentals on any conversation about commodities. The first is this notion about resource intensity, which suggests that until you reach the $16,000 per capita bracket, the resource intensity of the world and the economy will increase.
Right.
So in by 2007, the world average income per capita was about $10,000. The projections is that by 2022, this will be $15,000, of which, of course, you are counting on the upper income levels of the developed countries. The rest of the developing world is still below the $10,000 bracket. And earlier I'd mentioned that East African Community is targeting the $10,000 bracket by 2050. So which means that until you reach that kind of level, your resource intensity will increase. That means the consumption of minerals and other commodities per capita will increase.
Right.
That can justify, therefore, an effort into utilizing your commodities to build your infrastructure. Just to finalize, let me quote a very interesting study by Martin Schurmer from the University of Bonn that has produced a paper in 2013 which is called Industrialization and the Demand for Mineral Commodities, which suggests that a 1% increase in manufacturing output leads to, for example, 1.5 increase in the demand for aluminium and 1% increase in the demand for copper and so on and so forth. So essentially suggesting that greater industrialization will require more commodities, and industrialization is at the core of the EAC Vision 2050. So there is a future for commodity sector as long as we link it with industrialization.
So for us to remain relevant, we must manufacture. Thank you, gentlemen, for your insight. Unfortunately, we've run out of time. We have to put a pause there. This has been the East African Focus Debate by CNBC Africa, looking at developing the East African commodities market. I've had the pleasure of speaking to Dr. Kadri Alfah. He is the country manager for East Africa and Exchange, as well as Pedro, who is the director for sub-regional office for East Africa at UNECA. My name is Bonney. Tunya. Have a good day.